Have you ever wondered why an options price can suddenly jump or drop, even if the underlying stock has barely moved? It often comes down to the less tangible part of an option's value, known as its extrinsic value. Understanding what drives these fluctuations is crucial for any options trader, and this is where Vega steps in. Vega explains extrinsic value volatility by quantifying an option's sensitivity to changes in the underlying asset's implied volatility. Simply put, it tells you how much an options price will change for every 1% move in implied volatility. A higher Vega means the option's extrinsic value will be more dramatically affected by shifts in market expectations of future price swings. The core mechanism here is implied volatility itself. Options derive their value from the potential for the underlying asset's price to move significantly. Extrinsic value is the portion of an option's price beyond its intrinsic value, and it primarily reflects time value and implied volatility. When implied volatility rises, the market perceives a greater chance of large price movements in the underlying asset, increasing the probability that an option will end up in the money. This enhanced probability translates directly into a higher extrinsic value for the option, and Vega measures precisely how much that value shifts. Longer-dated options and those that are at the money typically have higher Vega values because they have more time for volatility to impact their potential outcome. For practical application, traders utilize Vega to gauge their exposure to market volatility. By knowing an option's Vega, you can anticipate potential profit or loss if implied volatility increases or decreases. This is particularly vital for strategies such as straddles or strangles, which are explicit bets on the direction or magnitude of volatility itself. For those looking to manage risk effectively, Vega provides a powerful tool to understand not just directional price risk, but also the often overlooked risk associated with changing market expectations. It is also fascinating to note that implied volatility is not uniform across all strike prices. This phenomenon is often observed through the volatility smile or volatility smirk. This means that Vega can vary significantly for different options on the same underlying asset, depending on their strike price and time to expiration. Vega itself is not static, as it changes as an option approaches its expiration date and as the underlying asset's price fluctuates, emphasizing the dynamic nature of options pricing. Ultimately, understanding Vega empowers traders to anticipate how shifts in market implied volatility will impact their option positions. This insight allows for more informed risk management, helps in constructing appropriate volatility-based strategies, and ensures greater preparedness for the dynamic and ever-changing conditions of financial markets.